Hello team, today we will understand derivatives, the forwards, futures, options and swaps. But for today we are going to understand futures and forwards. Okay, so our derivatives world is divided into two parts. We have over the counter derivatives, which are OTC, and we have exchange traded derivatives. Let us understand what will we cover for this topic in this session. So our agenda for today is that we will cover derivatives and introduction, a complete overview of what a derivatives market is all about, the difference between OTC and exchange traded derivatives, factors which influence the value of derivatives, forward contracts, how it is settled, futures contracts, what is a mark to market, what is a margin call, how does a futures contract actually happen, the futures price determination, why futures are called standardized product, the importance of daily settlement in futures, margins in futures, the settlement of futures, futures payoff and the major future exchanges in the world. This is the overview of the entire class. We will also show a video. We will do a simulation game and a sum so that you can understand the practicality of the aspect of derivatives. Okay. So, what is derivative? It is nothing but a product whose value is derived from the value of an underlying asset. An underlying asset can be anything. Financial products are also called as asset classes. So, you have bonds as an asset class, you have foreign exchange as an asset class, you have interest rates as an asset class, you have equities as an asset class. The value of these asset classes can be further subdivided into two parts, financial asset classes and non-financial asset classes. So, you have financial asset classes like bonds, equity, foreign exchange, interest rates, indices, and you have over the counter, you have non-financial asset classes like commodities. You have weather. Commodities could include hard and soft commodities. You could have rice, you could have wheat, you could have weather, you can have oil. So, you could have any underlying asset as the asset class. Primarily, derivatives is used as a hedging instrument. A hedging instrument means an instrument which helps you to reduce your risk on your current portfolio or your current contract or the position you hold in the market. Risk can never be made zero. A risk can be minimized, it can be mitigated by use of a lot of derivatives like forwards, futures and options and swaps. Forwards are primarily OTC markets, futures are exchange traded, options are divided into both parts, exchange traded also and OTC, and swaps which are primarily an OTC market product. So, let us understand what this derivative market is all about. This derivative market is really huge. If you see numbers numerically, you have 50 trillion as your world GDP, 100 trillion as a total value of the world stock and bond market, but whereas the global financial derivatives market really comes up to around $700 trillion, which is really huge. Okay. Why is derivatives always in the news? If you have to quote Warren Buffett, who says that derivatives are financial weapons of mass destruction which carry dangers that will, while they are latent is nothing, but when they are really active, they are really legally, they are very destructive. This could be seen during the subprime crisis when a lot of the companies went ahead and insured their derivative or their contracts with the help of derivatives to a thing called as swaps. So, CDSs was started by Blit Masters, who was a trader in JP Morgan Chase, and he created this product called as CDSs, which is nothing but insurance on swaps. They don't actually work like insurance. It is a method of mitigating your risk on the riskiest tranches of the mortgage-backed security sold in the market, which helped reduce that risk through a product called as an OTC derivative called as a credit default swap. Today, we will talk a little on forwards and a lot on futures, which are nothing but hedging instruments on different asset classes. Forwards could be into foreign exchange and commodities, and futures could be any financial or non-financial underliers. Moving forward, why do we do derivatives? We can do derivatives for speculation, we can do derivatives for hedging, and we can do derivatives for arbitrage. Arbitrage is taking advantage of price differentials in two different markets. Hedging is a method of reducing of your risk, whereas speculation is nothing but making a profit out of an underlying asset using a derivatives contract. Let's move ahead. Okay, so let us understand the first part of derivatives called as forward contracts. Okay, a forward contract is used for speculation and hedging. Derivatives are used for speculation and hedging, the risk associated with fluctuating of prices of assets. So the value of a derivative is derived from the value of an underlying asset, and in this example we have taken a forward contract example with rice as the underlying asset. So we can use it for hedging and speculation. So let's draw up a forward contract. Let's say maybe in India a Reliance Fresh can take a forward contract with a farmer. So let's say a farmer would like to sell his rice after a few months. He is growing rice and he's going to sell his rice after a few months, and let's say a rice flour factory person wants to buy that rice after a few months, and the rice flour person, the fear that he has is that the price of rice will go high, and because of which the profit margin or the spread he will make by selling this rice or this rice flour in the market will go very less, because the price of the rice will increase. Whereas the farmer has a fear that if the market falls down for the price of rice, he will earn a loss. So they both try to hedge their risk. When they hedge their risk, they enter into a forward contract where they agree to deliver a contract at a given rate, at a given date, and at a given price with a fixed underlying commodity. And these can also be regulated. Forward contracts can also be regulated. So what is the example given out here? The seller who thinks that the price of rice will go down in the future and he will make a loss if he holds the asset, whereas the buyer thinks that the price of rice will go up in the future and he will make a profit. So the contract here is that the asset has to move to the buyer, whereas the cash will have to move to the seller, and they enter into a contract to deliver this rice at say 120 kgs a kilo, wherein today the price of the rice may be 100. So what does the farmer think? The farmer thinks that the rice price may go to say 100, whereas the seller thinks that the seller or the buyer thinks that the seller or the farmer thinks that the price of rice will go to 110 from the current price of 130 or 120, whereas the buyer of this rice thinks that the price of rice will go to 150, even though the price may be 100 or 110 right today. So one has a very bearish point of view. The seller has a bearish point of view, whereas the buyer has a bullish point of view of the market. And because of this risk that they are involved in, this fear that they are involved in, they enter into a contract to mitigate that risk called as a forward contract. So you can enter a forward contract, but the person who makes a profit of this contract is called as a speculator. So derivatives can be used to hedge in the market moves exactly opposite to the expectation. You can hedge that risk, whereas you can also speculate by using these participants to speculate and make a profit if the market moves as expected by them. So if the market moves as your expectation, okay, if the price of the rice really goes high as what the buyer thought it will, then he has made a right decision and he enters as a speculator. But the other guy, he remains a hedger. That is all what forward contracts are all about. Okay, so let's draw up a forward contract. Just a specimen example. So what is a forward contract? Let's say the farmer agrees to deliver 100 kgs of rice at the rate 110 per kg on March 30th, 2017. Okay, now this is a forward contract whose value is derived from the value of the underlying asset, whereas the rice, the current market price of this rice can be around 100. So this is the current price of the rice, and the farmer thinks that the rice price is going to fall. He thinks the rice price in the near future, by the time comes for delivery, it is going to fall down to 90. Whereas this is the thought of the farmer. Whereas the person to whom he is going to deliver, the rice flour guy, he thinks the price is going to increase to say 120. So he has a very bullish point of view on the market because he is the buyer of the contract. Whereas the seller who owns this asset has a bearish point of view. So in this scenario, they enter into a forward contract where they agree to deliver the underlying asset at a fixed rate, at a fixed date. These are forward contracts. How do they become a speculator and how do they become a hedger? Depends on the spot rate on the expiry of the contract. So let's say on March 30th, the price of rice in the market is 120. So this is the first example, 120. What does the farmer happen? The farmer says, oh, the price of the rice has become 120, which means the amount of loss the farmer has made is 10 rupees per kg. Okay, so he's around 10 rupees per kg. This is the loss a farmer has made, which means he entered on his contract to mitigate his risk, but he has mitigated his risk but made a loss of 10 per kg. This is his loss. Whereas the rice flour guy, because he entered into contract, today the farmer has to deliver this to him at 110 a kg. He has made a profit of 10. Because he knew the market is going bullish, and it actually did, which means his position or his viewpoint or his speculative viewpoint was absolutely correct, and he has made a 10 rupee profit because he buys at 10 rupees lesser than the current market price. This is the first example. Let us take the second example. In the second example, let's assume that the price of rice falls down to around 100 rupees a kg. In this scenario, what does the farmer say? That it's great that he entered into this forward contract to hedge his risk, because now the farmer has made a 10 rupees profit and now he's become a speculator. Whereas the rice flour person has now made a loss of 10. So at least he has hedged his risk. No doubt he made a loss, but at least he's remained as a hedger. And this is how forward contracts are done. Absolutely physically settled. What has been your physical settlement? I give rice out to the person and he gives me cash. So this is called as physical settlement of forward contracts. Okay, so let's understand an example of a futures contract. The instrument type is a futures. Let's look at the future details. So the instrument type is stock futures. Our symbol is HCL Tech. This is today's opening high and a low price over here, listed out here. Okay, the option details of this entire contract. The expiry date is the 26th Feb 2015. Futures always expires on the last Thursday in India, and globally it settles on the third Friday. Whereas if you see the order book of the stock exchange over here, you can see the amount of quantities you can buy and sell, the buy price and the sell price. This is the auction book of the stock exchange where you can buy and sell your quantities. Once a person puts a buy quantity and price, if it matches with the sell price and quantity, the trade gets executed and it is irrevocable. It cannot be cancelled. This is the order book of the stock exchange, and this is the market lot of futures. So the 125 is a market lot. The value of contracts bought and sold today around 742,342, and the market lot of the futures contract is 125. The value of this underlying asset being traded currently in the market, in the live market, is 1899, and the number of contracts bought and sold today in volumes is 3113. Okay, so this gives us the basic fundamental details of a future contract, and if you see, everything is very standardized. The settlement is standardized, the margins are standardized. So let's look at what exactly are the different standardization parameters of a futures contract. The first parameter standardization is settlement date. So let's look ahead and understand what is the futures date. So the future contract standardization. The futures contract standardization is always on the last Thursday and the third Friday of the month. This depends on the market. Again, the contract size, the minimum contract value has to be around 2 to 5 lakhs. The lot size, the lot refers to the number of the underliers in each contract. If the lot size is 500, then each contract will derive it from the value of the 500 underliers. And the price tick. The price tick or the movement of a future is also standardized. If the price tick is around 0.5, then a price can also move from 100 to 100, 0.50, 101. That is called as the tick size of the stock. The other things which actually make futures standardized are the margins, it is the quality, it is also the currency pairs. If currency is the underlying futures standardization, if currency is the underlying in the futures contract. Let's say for example margins. The margins are predetermined by the clearing member, and hence it is standardized across all the participants in the market. So these are different kind of parameters which help futures to make it into a standardized contract. Let us understand a futures contract. Today, let us take an example of the underlier Bank Nifty. Okay, so for example, Bank Nifty is currently trading at 18,650, and the open position we have taken in the futures contract is one contract at the rate 18,650 for a Jan expiry, and the entire lot size we have taken a 10. The initial margin which the stock exchange has required that we maintain at one point of time is 25%, and our maintenance margin is 10, but the commission fee to our broker is 5 basis points. So if you go and check the entire contract value, a contract value is nothing but the underlier multiplied by the contract into the lot size, which is nothing but 18,650 into 1 into 10. Okay. From the 186,500, the initial margin that we need to really give the stock exchange is 25% of the contract value, which is 46,625, and the maintenance margin we need to maintain at every given point of time is around 37,300. If whilst doing the mark-to-market settlement, the mark-to-market settlement also means the daily calculation of profit and loss. While doing the mark-to-market settlement, if the margin drops below 37,300, we will have to top up, which means we will have to put in more money and bring the margin back again to 46,625. Let's assume on day 3 from 47,325 this really tanks down around 37,000. So, we have to top up around 37,000 minus 46,625, which is nothing but your variable margin, where the broker will give you a margin call. And the margin call, after a margin call, you will have to top up the variable amount of margin. So, let's understand a particular example. Let's say when you took this contract, the price of the underlier was around 1800, 650. Now, at the end of day 1, the closing price of this underlying asset, which is Bank Nifty, closes at 18,666, which is nothing but 16 rupees profit. This is a long futures. So, we are taking a position as a long futures contract. In a long futures contract, if you are if you're taking a long future, which is a buyer's position, you always make a profit when the markets are going on a upper side, which is you need to always be bullish on the market, and if the market goes bullish, you will make a profit. So, on this contract, the difference between 18,666 and 18,650 is 16 rupees. So, 16 rupees multiplied by one contract into the number of lots, 10 lots, gives you a 160 profit, which means the short futures person, the person holding the other position, which is a short futures position, has to give you a total of around 160 rupees. From this 160 rupees is what your brokerage or commission will go. So, even if you make a profit of 160, the broker will charge you around 5 basis points on this, which will be into your margin account, which is into your clearing account. So, closing price 8666, the daily profit and loss is 160, your overall profit is 160 again, obviously the total end of day profit, and the monthly profit is 160. The margin closes at 46,725, which is 46,625 plus the profit earned today, 160. This is the closing margin for today. This also becomes the opening margin the next day. On the next day, which is day 2, your market has moved much more in the bullish, in a bullish manner from 18,650 to 18,666, and on day 2 it has closed at 18,720, giving the long futures holder a 54 profit. 54 profit into one contract into 10 lots gives him a 540 profit, giving an overall profit in the contract for around 700. So, the closing margin of yesterday is 46,785 plus 540 daily profit and loss gives me a total of 700 profit. I close at a 47,325, which is 46,785 plus 540 giving me 47,325. This is a closing margin for today. This also becomes the opening margin of day 3. Day 3, the market tanked down to around 18,697, giving the long futures position holder a 23 rupees loss, which is 23 into 10 into 1, a 230 loss, reducing the overall profit to around 470. 700 minus 230 is 470, and the overall margin is reduced from 47,325 to around minus 230, giving me an overall margin of 47,095. In a scenario where I made a loss 230, the brokerage commission charge is 5 BPS, which means 230 into 5 BPS, which means my losses actually double. If I earn something, it is when I make a profit, my brokerage goes from the daily profit and loss. But when I make a loss, my brokerage is addition to this, which I have to pay double from my margin account or the clearing house account. This is how your futures are. Now, in this scenario, the 230 that is deducted from your account is paid to the short futures person. Thereby, if you see the short futures position calculation, the short futures on that day will have an increase in margin. Let us look at day 4. In day 4, again, the closing price was around 18,745. The market went bullish, giving a 480 profit. The closing profit now has increased to 950 and 47,575 will be my closing margin. Let's take the next day. The next day also I make a profit. If you see, simultaneously I'm keeping on making profits. Over here, if you see on day 8, I made a loss again, but I've got a huge loss. It closed at 1900 from the previous day close of 19650, giving me a loss of 6500. My overall loss, my overall profit has reduced to 3500, with my margin being 5125. At this point of time, if I think 3500 is a profit that I want to, the maximum profit I would like to bear, or maximum loss I would like to bear, I can also exit my futures contract. At this point in time, if I want to end my futures contract, I can by telling my broker that this is my stop loss and I cannot bear any loss anymore. So can I exit the contract? If not, till the settlement date, till the last Thursday, the third Friday, this contract keeps on being calculated, and in the end of the cycle over here, if you see, I've just given you an example till day 10. At the end of the cycle, if you realized, I've made a daily profit or loss. My calculation have ended at 0, wherein I opened at 46,625 and I also ended at 46,625, giving me a no profit, no loss scenario. This is how a futures contract is calculated. This keeps on moving till the remaining settlement cycle, till the last Thursday of the month. Any questions on this one?